Well, hello everyone. It's Ken Winans and Stephanie Larson, and we haven't done a video in about 3 weeks, 4 weeks.
Something like
So
that.
anyway, we thought it was time to get together and talk about stuff. So first off, I want to thank you all for those of you who did answer our survey. I mean, like you, I get inundated with these things, and I told Amy, please keep it under 10 questions. So I'm glad that you all found it very interesting. I did think you would find it of some interest of what most of you told us, and we are in agreement with you. You are concerned about the market right now. You're more concerned about playing a good defense than missing out on a possible rally. We completely agree. It was interesting that, like us, you were more concerned about inflation and government debt than COVID. And Stephanie and I were just talking about it. We think we're all kind of COVIDed out from the last 2 years. The other things and thank you again that you are using our portal. That's where we really do want you to be paying attention to your portfolio and certainly the videos. So we want to talk a bit about some developments in the company that you need to be aware of. One of the reasons we specifically asked the question about other services that we did form a joint venture with a firm called Access Wealth Management. Now, just to be sure you understand, we are an independent investment management firm. We did not get bought out by these people, none of that. This is a joint venture. They're an independent firm and we're independent. But they do offer the estate planning, the financial planning type components that we as investment managers typically don't do. And on the same side, they don't actually manage the portfolios. They retain a firm like us to manage. So any of you who put down that you would like to at least explore those things, please call Amy or Mindy and set up a time when you'd like to talk with the people we deal with, and we can certainly begin to describe what these things are about. Steffi, anything you want to add?
No, I mean that's a good point. We are working with Access. They're a bunch of really good guys over there that we're working with. We trust them a lot. We tend to manage their money for the clients, and in turn they can also offer the things that we don't, like retirement planning or insurance and all that kind of stuff. I mean, we're strictly money managers, so we want to manage the core assets. But the full financial advisor menu of items that sometimes people do want. We're happy to now be able to help provide that, at least through our partnership with them. So
Exactly.
we just want to make sure everyone has what they need.
Exactly, and it's just important for you to know that there's, although you certainly still have your accountants and your attorneys and always have them involved in the process, but this joint venture can add a lot of capabilities to what we already offer our clients. So let's talk, you're all talked about your big concern, as we just mentioned, was about inflation. Let's talk for a moment. I am sad to announce that the inflation situation is rapidly growing. For those of you who were around in the 1970s, as I've joked before, it's without the fun fashions and the fun dance music, yet we're going through the same stuff. Unfortunately, the remedy for this, or what we're going to have to deal with, is continued market volatility. There is a shift in market leadership. You're definitely going to see commodities and commodity type companies lead the next leg up in any kind of rally. And something to remember, a bear market, none of us like them. They're very volatile. There are different types of bear markets. I'm actually thinking about writing a Forbes article on this. But neither Stephanie or I think we're going to have the pullback we had March of 2020, and suddenly it's going to take off again. This is going to be much more of a multi-year, probably a sideways moving type market. So that much more important for us to not hang on to things or investments that are doing poorly and position money into, as I said before, commodity type situations. So we will continue to do that.
Yeah, and I think that's a really good point. I know a lot of you guys watch your portfolios every day. For mental health, I would recommend you don't do that, but yeah, I know you guys can help yourself. But you also get the alerts when we're trading from the custodians. You'll see that we've been actually really active this year, trimming and cutting and selling. Even today, we sold 4 more names and cut a 5th. So we're also still buying, and sometimes that might seem oxymoronic that we're trimming and raising cash or cutting names, but then buying at the same time. The breadth of what we're buying is actually getting pretty narrow. The market's not very favorable for stocks that are continuing in their uptrend. So what we're trying to do is really cut anything that's broken down, sell anything that looks like it's not going to come back. And then, but we're still trying to see if we can add a little value through stocks that seem to be holding okay, and that actually means through January. So, you know, if the earnings are good, the companies are strong, and they've weathered the year so far, we're going to at least commit money to that. But you will see that we have been very busy. We still have the hedges on the portfolios, and we're not have any intention of taking those off until the market dictates and tells us to.
And we might actually increase the hedges.
Yeah.
If the situation deteriorates in the market, and just so you all understand what a hedge is, basically it is a counterbalance in your portfolio. So you have a lot of stocks, and stocks, as a general rule, go up and down with the overall market. A hedge would basically counterbalance the volatility, and as we did in March 2020, where the market was down 35+%, our portfolios were down 11, and the reason was that the hedge in the portfolio actually made money while the stocks went down. We do that for a couple of reasons. Number one, it's awfully hard to liquidate an entire portfolio of stocks and then immediately rebuild it in a very fast moving market. It's just very hard to do, and it's very hard to do it efficiently. With a hedge, you can put it on and take it off and put it on and take it off very quick, very efficiently, and then build out the portfolios accordingly. Remember that the stocks in your portfolio, they generally are great companies, and a lot of times it's a guilt by association. Because they're part of the S&P 500 or the Dow Industrial Average, they will be sold just because they're part of those indexes, as
Yep.
other people are selling things.
Well, and that's also it. Actually, this would be a really good time to re-emphasize something. We do have several clients that have mandated restrictions on their portfolios. Some names that actually have gotten hit really bad this year. If you want to change your mind on any of those restrictions, you should reach out to me or Ken and let us know, because there are some names that we would actually sell that we can't sell. So I think that'd be a really good point. The restrictions should be renewed every year. So if you're a person that has them on your account, I actually highly encourage you to reach out. If we don't hear from you, we'll probably have Amy reach out and follow up and strike a conversation on that.
Yeah, I've said this many, many times over. You know, it's interesting. People do get enamored with a company, and I would just encourage you, do not confuse the company with its stock. They are not one and the same. In fact, you can have a wonderful company, and I'll bring a good example. I remember distinctly Amazon. In 2008, Amazon lost nearly 60% of its value. Had nothing to do with the greatness of the company, but it did take it several years to come back. And I just don't see the sense of taking those kind of body blows after we've had this tremendous bull market. So again, we work for you. You will have your reasons for what you do, but just would encourage you, this is not the time to be trying to restrict things. Now, let me just say a couple other quick things. There's a very good chance we're actually going to increase the exposure in your portfolios to the commodity ETFs. They're going up. If you look at them, they've been performing very, very well this year. We added gold not long ago. I actually think gold probably is, if the inflation thing continues to pick up, gold is probably undervalued right now. So you'll continue to see that. So again, we're not here to bet on things. Our job is to find investments that make sense during the current market conditions, and those ETFs, although I might have my reservations on their liquidity from time to time, they are definitely trending in the right direction. So that's something to keep in mind.
Yeah.
Stephanie, let's talk about bonds and preferreds real quick.
Let's circle back to the inflation,
Okay.
because Ken and I obviously talk about this every day, and to fulsomely close this subject, the inflation's obviously real. I feel it in my pocketbook, and it doesn't make me feel comfortable, but you know, energy is a huge component of it, but that doesn't mean that inflation isn't actually happening. You just go to Safeway or your local grocery store and you'll see the costs have gone up. So the big debate now is going to come from the Fed, and this will lead into the bond discussion. Mm-hmm. What's the Fed going to do? And it was actually heartening this week. Ken forwarded me the article on it. One of the Fed presidents, right? Mm-hmm. He was saying, hey, obviously we're going to raise rates. Let's stop talking in quarter points. We need to go a full point. That's aggressive, and he's not wrong. And honestly, Powell should have done it probably 6 months ago. So at the very minimum, start moving. I know he was slow walking it. He was trying to prime the pump and get everybody ready for it and have it get baked into the market, but he's late. and he should have done it, and he's gonna do it, and he's getting pressure from within to do it sooner rather than later. And actually, even on the political end, there are people in the Democratic Party who are clamoring to have Powell out. Now, obviously, he's not gonna be ousted, but he's gonna come under a lot of pressure, and Ken can talk to what happened in the 70s better than I can, but if you remember what happened, there were several Fed chairmen within a few years. It's not something we want to happen. We just need Powell to actually have some guts and to actually start raising rates. And even though most people would say it's probably baked into the market, don't be confused. The second he does that, especially if he does it without warning, the market's going to freak out. It's just going to happen. But it's good, it's healthy, and it's what needs to be done to stymie the inflation.
Yeah, and just keep in mind that the strategies we're using, if you go back in time, that's exactly a lot of the same strategies that my counterparts would have done in the 1970s. Commodity-based stocks, short-term bonds, very short-term type securities that don't, that basically weather the storm well. But also the one thing you all have to keep in mind, and I know many of you that are our clients were around then, to have money sitting around in cash, because you're worried about something happening in this country. Just keep this in mind. You are basically accepting a loss in the ability of that money to buy anything, and it's a loss you cannot write off on your taxes. You're far better off putting money to work in certainly shorter term bonds than to have it sitting in a CD or in cash in your bank account. So, and it's not, we're not doing this to try to get more money from you folks, but I'm trying to get you to think in terms of that this situation, according to my history studies, inflation lasts for 6 to 8 years. We're only 2 years into this. That means we've got to, I hope I'm wrong, but I don't think I am. To have that money sit around, especially if you're retired, is going to really begin to hurt as you go a couple years out. So if you want to talk to us about, even if you want it to be safer than the kind of bonds that we buy, fine. But you've got to find some way to generate some income on it to try to keep it, within range of buying power.
Yeah, that's a good point actually with the bonds. I mean, we buy the same bonds for everybody unless otherwise told not to, right? So we do have clients. All these portfolios are custom made. They're custom made because of when the account shows up, how much money's in there, what bonds I can find, and if there's any restrictions. If you said I want all this money to be matured in 2 years, I can make that portfolio. So if there is something like that and you want to have something pretty specific, we can make that. I mean, we do have some clients that also prefer not to be in oil or things like that. Again, we can custom make those portfolios. That's kind of the unique thing of the way that we manage the money, is that we design and strategize each portfolio for every client's needs. And if your needs change, you just need to let us know, and then we can make all the augmentations that we need to the portfolio.
Exactly.
Yeah.
Well, this video is going a little long, so we just wanted to give you a brief update. We're here, we're working every day. Thank goodness none of us have gotten sick, and we're moving ahead with things. We are going to be doing more business trips again throughout this year. Certainly we'll be doing some seminars in Southern California and in Las Vegas. So coordinate with Amy if you're interested in possibly hearing what those seminars are going to be about. Anyway, folks, we appreciate your business. We're here. We know we know how to handle this thing. And the nice thing is about all bear markets, they all do come to an end, and we've always made up losses very quickly. So just let's just stay the course. So we hope you're all well and happy, and we'll hopefully talk to you again in about 2 to 3 weeks.
Yeah, reach out anytime if anyone wants to talk. We're always here. And again, Amy's going to be circling around to everybody this year, reaching out to talk, and face-to-face if you want one, or if you want to have a meeting with us, we can always put it on the books. Especially, it seems through the survey that COVID's not as concerning. So if you ever want a face-to-face, just let us know, and we'd be happy to talk anytime.
Hey, real quick before we go, a little bragging rights. You notice behind us we still have our Morningstar medals. We just found out that, and one of the reasons Access is working with us is that we're one of 2 managers globally that have 5-star rankings in multiple asset allocation categories on Morningstar. I mean, there's a lot of people who are really good at one thing, but nothing else. Well, we've been able to cover a wide swath of different strategies, so I'm very proud of that. And quite frankly, if you talk to any of the representatives of Access, they will tell you that's one of the reasons they decided to team up with us, is that we have those capabilities. So Just to let you know that we are performing better than most of our competitors, and we're very proud of that fact. So folks, do take care of yourselves. Again, thank you for being Winans clients, and we hope to see you sometime soon. Take care.
Take care.